Welcome to this short presentation on the COVID-related Tax Relief Act of 2020. Although late in 2020, and depending on which cable news show you watch, there's joy or there's sorrow. In any event, and there's a lot of speculation about what's in the bill, what should be in the bill, what I can tell you is what is in the bill, and I can tell you that the check is in the mail. We know it's for at least $600, and it may be for as much as $2,000, so we're going to keep our eye on that. But right now, that's the only thing we don't know about this bill. How much will the check eventually be? We know a lot about what else is there. We know there's an additional 2020 rebate for everyone except those who make more than $75,000 a year. We know the deferred payroll tax collection is extended. We know there's guidance that clarifies that personal protective equipment qualifies for the educator expense deduction. We know that there is final clarification of the PP loan forgiveness and how we deal with expenses paid with the loan proceeds. There's additional guidance on emergency financial aid grants to college and university students. We're given guidance on the tax treatment of the forgiveness of various loans, and I counted there are 5 different loan programs under the COVID relief, not just the payroll protection plan loan program. And the IRS is given authority to waive 1099 reporting of loan forgiveness amounts and more, as they say in the ads for automobile dealerships, and more. Look here too, in the Taxpayer Certainty and Disaster Tax Relief Act of 2020, there are over 4 dozen credits and deductions extended for periods lasting from 1 year to 5 years, and in 12 cases made permanent. If we could be permitted to call anything permanent when referring to federal income tax law. The Taxpayer Certainty and Disaster Tax Relief Act of 2020 is not part of this short program, which of necessity is devoted only to COVID relief checks, financing, and the treatment of deductibility of expenses. A program on that Disaster Tax Relief Act will be available in a few days. It'll be, as we say, on the next bus. Additional 2020 recovery rebates for individuals are the big news. A refundable tax credit in the amount of $600 per eligible family member, which phases out starting at $75,000 of modified adjusted gross income, $112,500 for a head of household, and $150,000 for married couples filing jointly at a rate of $5 per $100 of additional income. Now I figured that out. If it's a $600 amount and it phases out at $5 for $100 of additional taxable income, that's a $12,000 phase out range at a rate of $5 per $100 of additional income. So if you had $75,100 of modified adjusted gross income, your refundable tax credit would be $595. That's probably the only real example I'm going to give you of doing any kind of math. Advance payments will be based on information in your 2019 tax return because you haven't filed 2020 yet, obviously, right? Eligible taxpayers treated as providing returns through the non-filer portal in the first round of economic impact payments will also receive payment. So if you are an eligible taxpayer, but you were treated as providing a return under the non-filer portal in the first round of payments, you are going to be treated as a non-filer under this round, and you will receive a check. Payments may be issued to non-filers based on information provided by the Social Security Administration, the Railroad Retirement Board, and the Veterans Administration. Married taxpayers filing jointly may receive payment for the spouse with a Social Security number while being denied a payment for a spouse without one. Now that occurs typically where we have a U.S. citizen married to a non-citizen, and the non-citizen doesn't need a Social Security number. In that case, the spouse who is a U.S. citizen would qualify for the $600 refundable tax credit, or perhaps a check, while the spouse without a Social Security number would not qualify. So that married couple filing jointly would only qualify for a $600 payment. Taxpayers who receive an advance payment that exceeds their eligible credit will not be required to repay any amount of the payment. If the credit determined based on the 2020 return exceeds the advance payment, the difference will be paid. So you can't lose, and you can win and you can't lose in this program because the federal government wants to give you money. Payments are not subject to administrative offset for past due federal or state debts. So the IRS cannot levy these payments. They cannot seize these payments. You're going to get the money. They're protected from bank garnishment or levy by private creditors or debt collectors. The bottom line, the United States government is giving away money for the purpose of rescuing the economy, and it wants you to get your share, hoping, by the way, that you will spend it. Some will come in a government check. Some you may get from your bank in a second round of PPP. The deferral of payroll taxes is also extended. The original payroll tax deferral period, 9/1/2020 through 12/31/2020, required employers to increase withholding and pay deferred amounts ratably from wages paid between January 1st, 2021 and April 30th, 2021. This legislation extends the repayment period through 12/31/2021, and no penalty or interest will accrue until after January 1, 2022. Next, the Secretary of the Treasury must issue guidance or regulations providing that personal protective equipment, PPE, and other supplies purchased by educators and used to prevent the spread of COVID-19 are to be treated as eligible expenses for purposes of the educator expense deduction. Those regulations or guidance must be retroactive to costs incurred on or after March 12, 2020. And there's your friendly banker, giving away money. When did banks ever give away money? Well, they're giving away money now. Gross income does not include any amount that would otherwise arise from the forgiveness of a PPP loan, the Paycheck Protection Program loan. Now, there are other loans. We're going to talk about those a little later in the program, but right now we're talking about the PPP loan. Deductions are allowed for otherwise deductible expenses paid with the proceeds of those loans that were going to be forgiven, and your tax basis and other attributes of the borrower's assets will not be reduced as a result of the loan forgiveness. This provision is effective as of March 27, 2020, provides similar treatment for second draw PPP loans, which you haven't taken yet. So you're going to be able to borrow a Paycheck Protection Program loan, knowing, one, that you will not be required to pay it back, and two, that the expenses that you pay with it will be deductible, eliminating uncertainty that beset the first round of payments. Next, emergency financial aid grants to students. The CARES Act provided for emergency financial aid grants to qualifying college and university students. This legislation provides those grants are excluded from the gross income of those students, holds them harmless for purposes of determining eligibility for the American Opportunity and the Lifetime Learning tax credits. The provision is effective as of the date of enactment of the CARES Act, March 27, 2020. Now we come to forgiveness, and I thought this illustration was particularly appropriate. Although we don't have to get on our knees, the loans are simply going to be forgiven, not just the PPP loans, all of them. Gross income does not include forgiveness of any loan in this program. The emergency EIDL grants, loan repayment assistance provided by the CARES Act, and deductions are allowed for otherwise deductible expenses that you pay with those amounts. They're not included in income. You do get to deduct the expenses that you paid with them, and other tax attributes will not be reduced. So if I purchased a capital asset with some of those loan funds, which is a little iffy, I will still be able to depreciate the cost of that capital asset. Now, we weren't supposed to purchase capital assets with those loan funds, so I'm not sure exactly how all that's going to work out. I trust that you use the loan funds for expenses, for the expenses that were in the list of qualified expenses for which you borrowed the money. They're effective for tax years ending after March 27th, 2020. Similar treatment is provided for targeted EIDL loans and advances and grants for shuttered venue operators. That's effective after the enactment of this legislation, which was either late at night on 12/27 or this morning on 12/28. We have the IRS has the authority to waive certain information reporting requirements. They will do that. There will not be 1099s issued reporting income by reason of the exclusion of covered loan amounts being forgiven, the exclusion of emergency financial aid grants from taxable income, or the exclusion of certain loan forgiveness and other business financial assistance under the CARES Act. All of it, none of it, is going to create taxable income, and so you should not receive a 1099. Now, to talk about retired individuals and their access to retirement funds. Here we have the application of special rules to money purchase pension plans. Money purchase pension plans were left out of the special rules in the CARES Act. The CARES Act temporarily allows individuals to make penalty-free withdrawals from a list of retirement plans. Money purchase pension plans were not in the list. But you can make these withdrawals for coronavirus-related expenses. The taxpayer can pay associated tax over 3 years, or can put the money back over 3 years, or can pay the tax over 3 years. This legislation just simply clarifies that money purchase pension plans are included in the list of retirement plans that are qualified for these temporary rules, allowing a participant in the plan to borrow money, repay it over 3 years, or to recontribute over 3 years. Now, a word about farmers. The legislation includes a provision that allows farmers to waive application of certain modifications to farming losses. Farmers who elected a 2-year net operating loss carryback before the CARES Act can elect to retain that 2-year carryback rather than claim the 5-year carryback period provided in the CARES Act. That was not clear in earlier legislation. This legislation also allows farmers who previously waived an election to carry back an NOL to revoke the waiver. And these clarifications eliminate, hopefully, unnecessary compliance burdens for farmers, so the farmers can have whatever NOL carryback period the farmer wants. 2 years, 5 years, waive the carryback period altogether, change what your election was to get the maximum benefit. We want the farmer to get maximum benefit from any current loss. The provision applies retroactively as if it was included in Section 2303 of the CARES Act. And these retroactive applications could get confusing if you don't understand just treat all of these, just compress all of these, the CARES Act, this act, the FFCLA, whatever it is, all of those, if you mentally compress those into one, you'll have it about right. The Congress passed the law, then they retroactively amended it, then they retroactively revoked it. So you have to have this latest legislation in mind when you're reading the earlier legislation, because some provisions in the CARES Act don't apply anymore. And then, of course, we always have the auditors. In this case, the CARES Act authorizes the Comptroller General to collect the monitoring and oversight of the Federal Response Act, but it turns out the list of committees to whom the auditor is required to report was short. After the passage of this legislation, there are 2 more appropriate congressional committees. The Senate Finance Committee and Ways and Means of the House of Representatives. Those 2 powerful financial committees were left off the list. this section includes those two committees in the appropriate committee list. So the Comptroller General is going to report to Senate Finance and to Ways and Means on the authorization, the implementation of all the provisions in this legislation. Can't make this stuff up. They can't even write a law that they can live with themselves. They left themselves out of the original legislation. Disclosures to identify tax receivables not eligible for collection pursuant to qualified tax collection contracts are part of this bill. Section 1205 of the Taxpayer First Act excludes Social Security support programs, SSI and SSDI, from the IRS private debt collection program beginning on January 1, 2021. The IRS and SSA need statutory authority to share information. The Taxpayer First Act revoked the authority. Now they find out they need the authority to share information so one bureaucrat can talk to another. And that's what this particular provision is about. I don't expect it's going to be nearly as interesting as the forgiveness of loans and the deductibility of expenses. There's a modification of protection for taxpayer return information. That explanation is complex. All you need to know is at the bottom, and it's underlined. The provision in the current legislation unwinds the changes made by the CARES Act and restores taxpayer confidentiality protections to the tax return information shared by IRS, while allowing certain uses as requested by committees that have only education jurisdiction. This is for the grants that are made to colleges and universities and then are supposed to be made to qualifying students under regulations from the DOE. The election to terminate the transfer period for qualified transfers is something employers do. If you've got an overfunded pension plan and an underfunded retiree health and life plan, you can transfer money from the pension plan if it starts out 120% funded and you maintain it at least minimum 100% funded, as explained on this slide, this 2 of 2. If you're 120% funded when you start and you maintain your pension plan at least 100% funded, it's okay for you to take money out of the pension plan and put in the employee medical and life plan. That's to balance the retiree benefits. You don't want to run out of money in the medical plan and be overfunded in the retirement plan. That didn't have a lot to do with COVID, as near as I can tell. Now, speaking, oh yeah, if you're sick, or you got people that are sick, boy, that's the best illustration of sick I've seen in a long time. This dude is sick. The extension of credits for paid sick and family leave is part of this legislation. It extends the refundable payroll tax credits for paid sick and family leave, which were originally enacted in the Families First Coronavirus Response Act, through the end of March 2021. So there's an extension. It also modifies the tax credits so they apply as if the corresponding employer mandates were extended through the end of March 2021. So it was going to end by December 31st, 2020. It's extended through March 2021, and it's effective as if included in the FFCRA, Families First Coronavirus Response Act. The election to use prior year net earnings from self-employment in determining your average daily and self-employment income for purposes of credits for your own paid sick and family leave. A self-employed individual who's sick needs to know what their average daily earnings are. Individuals may elect to use their average daily self-employment income from 2019 rather than 2020 to compute the credit. This provision, once again, is effective as if included in the FFCRA. Certain technical improvements are also made to the credits for paid sick and family leave. The legislation coordinates the definitions of qualified wages within the paid sick leave, paid family and medical leave, and the exclusion of such leave from employer old age or OASDI tax. they had three different definitions for three different paid leave provisions when they only needed one. So this gives us a single definition, which is effective as if that definition was included in the FFCRA on April 1st of 2020. Well, gang, that's it. Thank you for your kind attention. Thank you for being part of the South Carolina Association of CPAs and supporting our continuing professional education effort. And remember to stay safe and be well.